Hello, everybody. This is Noah and John, and we are from Urban Digs. And today we are talking Manhattan, Johnny. And we got a frequent member of this podcast and one of my favorites guests for this show because he always tells it like it is. Ari Harkov. Thank you so much for joining us. He is part of the Harkov Lewis team over at Brown Harris Stevens, and these guys just produce year after year after year. Consistent production. Johnny, we got them all to ourselves for the next 20 minutes. I know you got questions.
Let's rock and roll.
We're gonna go right into it. Ari, please start out and tell us, how is today's market doing? Is there anything different about today's market than in the recent past? Please let us know.
Yeah, well, first of all, thanks for having me. Always a pleasure. You guys know I rely on all of your data for our clients. We look at the charts at our Monday meeting every Monday, so thank you for all your work. This market, I mean, so it's interesting, like the first 2 months of this year, I guess we're officially in the last day now of February when we're recording. The first 2 months of this year, I feel like we've already kind of almost had three markets. There was the kind of like early mid-January market where it felt a little kind of dead, a little quiet, a little bit scary. Felt like things were really kind of slow to take off. Then we had a couple of weeks in there where it felt like the market was really getting legs. I was, seeing and hearing anecdotal reports of, big open house turnouts, some, lower price points in Brownstone, Brooklyn, hitting, 40, 50 plus groups, bidding wars. Felt like, kind of the market was really taking off. And then I would say in the last kind of 1 to 2, maybe 2 to 3 weeks, it feels like things have slowed down a little bit. I don't know if it's a kind of slow and gradual uptick in interest rates, if it's a lack of kind of, consistent new supply coming on the market, but it feels like we're living in like, a third market in only 2 months so far this year.
Very interesting. That the fact that the market's moving in and of itself is interesting. All right, before we go on to the next question, may I just please follow up and get a sense in terms of pricing? Are you sensing that this market, have we been going through a downturn? And do you kind of think we're bottoming, or are we coming out of it, or what are you seeing out there?
I think it depends on the submarket. So I think, Manhattan and Brooklyn have obviously behaved differently, as you guys have observed in your data for the past couple of years. And then I think within Manhattan and Brooklyn, different submarkets have behaved differently. I would say kind of 40,000 foot level, I think it feels like the bottom is behind us, at least for this cycle, presuming there's no kind of hard landing and dip into a recession. So on a high level, it feels like the bottom is behind us. If you look at Brownstone, Brooklyn townhouses, kind of the most active dynamic pockets of the market, I would say there really was no price downturn. And if anything, maybe the rate of appreciation slowdown. I think if you look at, kind of core Manhattan, desirable neighborhoods, downtown, condos, what have you, near the park, I think the market has been relatively flat. And then I think if you look at kind of, secondary locations in Manhattan, the Upper East Side co-op market, units that are unrenovated, the types of, kind of submarkets where things have been lagging a little bit, I think we definitely experienced a downturn. I think, prices definitely came off a little bit and maybe we're kind of bottoming out, but definitely doesn't feel like we're on a rise in those sections.
I mean, this is why I love talking with Ari, because there is no one single market. And Ari is one of the smartest guys out there, and he can pinpoint the different markets that make up the overall thing. I think it's fascinating. And Ari, I just want to dig in a little bit because you mentioned, at least at that overall level, some different frequencies to the market. And usually when we look at it, we think in terms of seasonality. We think January is kind of quiet. February is a bit of a bridge month. We get into April, May, June. That's typically when Manhattan, somewhat of Brooklyn, sees the most deal volume. And obviously that's a very abstract view. And I'm curious, when you look at it from these very localized viewpoints that you're taking, I'm wondering if are there any patterns that sort of that you can extrapolate? I mean, when you look at, say, cash buyers or mostly cash buyers versus financed buyers, like how does that look? And I'm just curious, does it look like anything is changing at that level?
Yeah, I mean, I think there's a lot to unpack there. So the first is you could think about it in terms of property type. So certain types of properties are going to be more seasonally cyclical based upon kind of the demographic of who's buying and selling those units, the tie-in to the school calendar year or lack thereof, the price point and kind of travel patterns of those demographics. So, if you're selling a very high-end unit in August, your buyers are not in Manhattan. They're out in the Hamptons or wherever they are. In December, January, they're in Aspen or wherever they winter. If you're dealing with a Brooklyn townhouse where I'm not supposed to use the F word, but families are generally more tied to the school calendar year, you're going to see a lot more activities. You get into kind of like mid-late spring with people looking to sell and get into their new home before the school calendar year. And if you're dealing with kind of a loft downtown where your typical demographic might be like a young finance guy, single guy, or maybe a young couple without children or something like that, then that's a different animal. So to go back to your comment, the different pockets of the market seasonally will respond differently. In terms of movement around cash buyers and financing, Minnow and I were talking about it the other day. I'm seeing, and I think your data bears this out, more cash buyers and more cash heavy buyers. So what I mean by cash heavy is people who are putting down anywhere from kind of 40% or more. I'm seeing more of those buyers than I've ever seen in my almost 20-year career doing this. So whether that is indicative of the interest rate climate, whether that's indicative of those folks feeling like maybe they can get more value, whether it's indicative of kind of the consolidation of wealth and affluence and more affluence in less hands. I think it's a variety of factors, but the cash buyers are obviously more nimble. They're not responsive to interest rates. They're not, they're not on a bank's timeline. They can move more quickly. And so I think those folks will buy when they find the right property. The flip side is they won't buy if they don't find the right property. And we're seeing a lot more pickiness for them as well.
This is such an interesting market, our New York City market. I mean, this is one of the reasons why the cash element, the international demand that comes in, and I don't even know if we're at full capacity. We talked about that from the pandemic, how we got our capacity cut down and we've been slowly getting more and more online to full capacity. I don't even know if we're back, but we got these cash buyers probably that came in from the interest rates. But you made a really good point. It may not be the interest rates. It may that they're just trying to extract more value in their bidding process. Maybe they're in a competition with somebody else and they want to sweeten the offer a little bit. But at the end of the day, we got that element at play with the cash buyers. We got the rental market that did its thing. I know it softened a little bit, but it did have a notable move higher over the last 3 years, let's face it. And I'm wondering, Ari, in your opinion, do these elements contribute to maybe putting some type of a floor on our markets in these down cycles?
The answer, I think, is 100% yes. So if you think about the market in its simplest terms, or frankly any market in its simplest terms, you have supply and demand, right? And so on the supply side, you've got tremendous constraints from zoning perspective, rent stabilization and housing units that can't be converted or delivered to kind of a free market for sale market. You've got obviously Manhattan being a fixated island. You can't physically expand out. You've got landmarks. You've got all these different layers. But from a supply side, we're incredibly constrained. And then on the demand side, because of what you're talking about, the affluence, the amount of cash, the ability for or the desire for people to live in New York City, and the fact that we were talking about this the other day, but you need a place to live. I mean, unless you're popping up a tent on the Manhattan Bridge, which I think a guy did at one point during COVID, you got to either rent a place or buy a place, right? And so because the rental market is so strong, and yes, it's come down from its peak, but it's still incredibly strong, and rents are up tremendously from where they were in 2019 pre-COVID. My alternative to buying is still extremely expensive, and that props up a floor, I think, on the rental market, on the for sale market, excuse me, in New York City. It's also interesting and worth noting that if you look at the U.S. housing landscape, roughly 2/3 of Americans own their home, roughly 1/3 rent. That's the inverse in New York City, roughly 2/3 rent and roughly 1/3 own, and I think that also props up the floor.
Interesting. Now, we've talked a lot about the markets, but we're kind of talking about them from the market's point of view. And I wonder if you could step outside and talk about some of the uncertainty or some of the unknowns that are kind of clouding today's market. I mean, I know we've got an election year, we've got rates, and I'm just curious, what kind of chatter are you hearing, and how do you address some of these issues when talking about the market?
I think you hit the nail on the head. I mean, the two big uncertainties for 2024 are obviously A, what's going to happen with rates, and then B, what's going to happen with the election. So on the election front, I think, I'm hearing two camps. I'm hearing the we already did the Biden-Trump thing. We know what's going to happen. We've had them both as presidents. We're going to get one of them. We sort of know what we're getting at this point, the blue tie or the red tie, but we know. And so there isn't a lot of uncertainty. It's going to be what it is. It'll be messy and annoying and whatever, but basically life goes on and there should be limited to no, disruption to the market. That's kind of camp one. Camp two says, no, it's going to be really ugly this time. You've got a lot of people who are very concerned about, stability around a potential Trump reelection. You've got a lot of people who are very concerned about, Biden's mental acuity and his age and having, an 85 or an 86-year-old finishing out a term in the White House, whatever the concerns are on both sides. And there's going to be a tremendous amount of analysis paralysis that comes as we get into the latter portion of the year. And that's going to really slow down our market. I can't tell you who's right or wrong, but, those are kind of the two camps that I hear in terms of chatter. And then the interest rate side, you've got the buyer camp and the seller camp. The buyer camp is saying, let's wait because rates are probably going to come down. It'll be, cheaper for me to buy. And unfortunately, you have a lot of sellers who are saying, let's wait until rates come down because then, my home's going to be more valuable. I don't want to put it on the market right now. And so you still have, some kind of softening of demand, both demand for purchase and demand for listing your home.
Yeah, we need to get those buyers and sellers on Macro Monday to let them know that these rates are not getting lowered anytime soon. In fact, they keep pushing those goalposts farther and farther out with each of these inflation prints that just doesn't go the way the Fed wants. I mean, I think the first cut is June. I'll be surprised if they cut more than a couple times just to normalize rates this year, unless, of course, something breaks. But none of us want to talk about that.
Yep.
All right, back to price action for New York City. I mean, I think about the cycles that we had. 2014, 2015, that was pretty much our last big peak. If I think about it, and we've had that progressive decline from 16, 17, 18 into 19. And we had a little bit of a bounce off that, but then the pandemic came and put us into another down low. And ever since then, it's really been kind of trying to recover from that. But I'm not so sure we ever get back to that 2015. It's almost like a lost decade here.
Yeah, we were talking about this the other day. I mean, I think you have a lot of people who either are unaware of the mathematical reality or don't want to face the mathematical reality or don't want to talk about it out loud. But in the interest of full candor, you have a lost decade in New York City real estate. I mean, we frequently talk to owners who bought anywhere from sometimes as early as 2013, but let's say 2014 to 2019, who are, on a nominal basis, either anywhere from losing money to, kind of breaking even to maybe making a few dollars. And then on an inflation adjusted basis or an opportunity cost adjusted basis, they're taking a bath. And by the way, this happens in all submarkets. I mean, a lot of people think, oh, Brooklyn's amazing. Prices have gone up so much. I mean, you can show them the data, but the answer is no, not really. Some pockets, yes, but overall, not really. And so, yeah, I mean, it's really wild. I mean, if you look at, if you were to put $1 in, if there were an index fund for New York City real estate, if you were to put $1 in that fund on January 1st, 2015, or you'd put that dollar into an index fund, that was tracking the S&P, I mean, it's like we're on different planets in terms of, the return or lack thereof. So, yeah, it's been really hard. The combination of regulatory headwinds, all the kind of legislation that's come out of Albany, the rent, regulations in 2019, mansion tax, transfer tax, COVID, work from home, the whole thing. I mean, it's been a rough go for New York City from a value proposition for a decade now. I'm not talking about a year or two.
Yeah, this started in 16. This started in 16, and we had the SALT deductions go away. We had the LLC situation change. There was that pied-à-terre thing that never really, I don't think it materialized, but that was lingering out there. You mentioned the rent regulations. You mentioned the mansion tax. You mentioned the ground zero for the pandemic, work from home with our commercial market. So many things. Yet, you know what? Considering now that I'm thinking about it, it's not that bad that we're kind of only where we are. We've recovered from the down cycles. It's just that we haven't appreciated under those macro situations. But how could you? I'm surprised we're not down 30% when I think about it.
New York City real estate is unbelievably resilient. And I think any of us who were in it, knew that in the early days of the pandemic. The flip side is, you have a lot of people who are going to compare it to the other asset classes, be them, whether you're looking at equities, bonds, crypto, U.S. housing market. I mean, look, the U.S. housing market is up plus or minus 50% from, pre-COVID until now in terms of the median U.S. housing price. I mean, so it's a 50-point spread between, Manhattan and the rest of the country. I mean, that's a lot.
Yeah. But you can't live in those. And there are some different tax structures. But yes, I hear what you're saying.
Yeah, no, for sure. And look, it's just painful. I mean, it's painful as an owner to, buy a home in 2017 and speak to your broker in 2024, and they tell you you're up 7% gross. I mean, it just doesn't feel good.
Yeah. And I think the same is true on the buy side, because, we like to view buyers as sort of there's a herd mentality. They like to buy when prices are going up. I think there's a bit of a comfort in feeling like you're going with the flow. And yet that's really, in hindsight, that's not the best course of action. Like, you don't want to be the person who's buying in, mid 2016, 17, paying the high price because prices are going up. That's usually a recipe for a whammy. So I'm curious, now that prices have come down, at least they've moderated a bit, volume is kind of quieted down. In terms of the buy side mentality, a lot of buyers are a little bit cautious, nervous. They're hesitant to go out. And I'm curious, when you do see those buyers who are out at the open houses, who do coming through to your listings, and there's a sense of nervousness, there's a sense of concern, how are you discussing the current market? How are you discussing this process with them?
So I think there are a couple ways to think about it. I mean, so first you start off with some basic math. So if we go back to the whole, I've got to live somewhere conversation, I can rent apartment A or I can buy apartment B. Yes, interest rates have obviously ticked up. The three of us, of course, know that historically they're actually not that high, but relative to where they were, they're obviously much higher. So let's do some basic math. Let's look at, if you were to rent this apartment, what are you going to pay every month? If you're going to own this apartment, what are you going to pay every month? Factor in, the principal repayment, which is not really a true expense. Factor in, the tax savings, and look at that mathematical spread and see what that is. And sadly, I will tell you, in most cases for the for sale housing market, there's still a fairly meaningful spread even in today's market, given where rates are, and even with rents as high as they are. Then you sort of start to get into the qualitative aspects of, owning a home, the ability to, make it your own, to stay there. Your landlord's not going to jack up your rent. The building's not going to be sold out from under you. You have people who are going to be more consistent neighbors, the community aspect, the qualitative pieces, which are hard to kind of capture in a spreadsheet. And then the last piece is, putting aside the fact that we just lost, a decade in terms of appreciation. If you look back and you take kind of a bigger picture, more macro view on real estate overall, generally speaking, if you buy a home, you own it for at least 5 years in New York City, historically, and in most parts of the country, you're going to do well and you're going to outpace what you would have achieved financially in a rental. So I think that's the kind of general calculus for most people, but I don't see many buyers out there thinking today that I'm going to buy today and it's going to be worth, 30% more in 3 years. I don't think very many people have that mindset.
Good. I think that's a good thing. Can we do the same exercise for sell side? What if you have a stubborn seller? What would the approach be there?
So it depends on obviously their circumstances. So, if you have a seller, we have a couple of these right now. If you have a seller, let's say who has an investment unit, a lot of these sellers, I think, are coming to the reality that, the cap rate and the yield is atrocious. I mean, I can get 5% in an online savings account. I mean, what am I doing getting 2% on my Manhattan condo, and actively managing it and dealing with the headache and the rest of it? So I think a lot of the investor sellers are sort of coming to the reality that, the yield is terrible, the equity upside may not be there, and the liquidity and the benefits of, passive ownership, of a passive asset, not real estate, are so significant that it's just time to kind of fish or cut bait. And for those people who haven't run those numbers, we tend to, walk through them, and they're fairly convincing, I think. Then you get into more kind of like the, I own a home, I'm thinking about selling, but I'm not sure because, I'm not going to get the price I wanted to get. But I'm really, I'm ready to make a move, whether it's because I've physically outgrown my space, I'm ready to leave the city, I want to be near my grandkids in, North Carolina, whatever the motivating factor is. And for a lot of those folks, I think it's sort of like, a combination of A, making a lifestyle decision, and B, recognizing, and we were talking about this the other day, Noah, that, a lowering of interest rates doesn't automatically mean that values go up. So if you think about, if rates came down 100 basis points, 150 basis points, whatever you think the magic number is, and they start to move into the fives, that's absolutely going to bring more buyers into the market, but it's going to bring more sellers into the market as well. And those sellers, in many cases will also be buyers, because most sellers are buyers and most buyers are sellers. And so some of that rate movement will negate any sort of price increases. It will just create more activity in the market, which for us as brokers is great, but for an average seller doesn't mean that their home goes up in value. Essentially, if you extract investors, first-time home buyers, and second or beyond home buyers, almost all buyers have a place to sell already. And so those sellers become buyers, and there isn't necessarily price growth. So, we try to kind of lay all that out for sellers. And I think just, if you look at a decade of no appreciation, you start to scratch your head and say, maybe it's just time, and to your point, there's liquidity in the market. You can sell your home. New York City real estate is active. It's not dead. No, it's not Miami, but it also isn't Miami in 2008 either. So, it goes both ways.
Yeah, it's a fantastic point. And, just as an aside, when you look at sort of the trends in pricing, it really is sort of cyclical. And of course, the cyclical nature of it is not really dependent on anything inherent inside the market. Obviously, there's a lot of inputs going in, but it does seem to run in definite trends. It'll run up, then it'll kind of take a cool off, run up. You never know what's going to happen, but you're absolutely right. The long-term trend is up. We're just in a down part of it right now. What I want to get
100%.
back to, though, is you mentioned some of the uncertainties we were talking about earlier, work from home, et cetera. And here we are, we're in New York City. It's the densest city in the United States. It's a fantastic place to be, but it's getting hurt from work from home because obviously people would rather be outside of the city. And I'm wondering, Ari, when you look at the Manhattan and the Brooklyn markets and you think about what makes a city great, and it's not necessarily sitting in your living room working, but it's human interaction, et cetera. How do you foresee, and you can break out your crystal ball, put on your Harry Potter sorting hat. I'm just curious how you see sort of the future of this city in terms of interconnectivity of people in a sense, and how that's going to power the market going forward.
It's a great question, John. And I think it's a question people are not asking enough, because I think it is the question for what happens with our market going forward. And by the way, to me, it is the vast majority of the explanation for that 0% price growth to 50% price growth spread that we talked about, compared to the rest of the U.S. So the good news is the return to office, while very slow and gradual, is slow and gradual, and it is happening. And there is a snowball effect to it. And while you're not getting the Monday to Friday, 9 to 5 or 8 to 6 in the office crowd, really returning in any sort of significant numbers, even starting to come in 2 days a week, 3 days a week, 10 to 3, 11 to 4, 8 to 5, whatever the hours are, you're starting to get to a point where slowly but surely you're seeing people who say, okay, I've reached a tipping point where, commuting from Fairfield, Connecticut, or, Westchester, whatever it is no fun. And as those buyers or as those individuals start to, tip into that kind of, I'm commuting enough that it's a pain and it's not worth it to me, they then become buyers. So I think that there will continue to be this kind of slow, gradual return to, the desirability of living and owning in New York City, based upon kind of the slow, gradual return to office. I think that's sort of one answer. The second answer, which the city, frankly, has not done a great job at, and it's not a simple one, is starting to look at, more office to resi conversion, which obviously, as we all know, office buildings make terrible apartment buildings, effectively means rezoning and probably demolishing buildings. And to demolish a building, you're almost reliant on the owner giving back the keys and the lender sort of like, taking pennies on the dollar. That's a very long cycle, but I think you're going to start to see some of that as these kind of like long-term office leases slowly but surely start to roll. The debt starts to roll on these buildings, and I'm not going to say that there's going to be a tsunami of real estate foreclosure in the commercial real estate world, because I actually don't believe that that's what's going to happen. But I do think that there will be some significant pain to be felt that has not yet been realized because of the long-term duration of cheap fixed rate debt, as well as big office leases that corporations don't want to default on. So I think there's going to need to be some movement from a kind of governmental perspective to rezone and revisit some of those areas. And there's been conversation around, how do we better use office buildings? Maybe, you have more schools, maybe you have more medical, maybe you have more, second, third floor retail. Maybe you do things that can, activate the spaces, to use, kind of a fancy word, as opposed to just sort of like the traditional office with cubicles. Beyond that, I think you're running into real issues as a city. I'll be perfectly blunt. I think you run into real issues as a city because I think that if you and I'm sure you guys do this, if you walk around pockets of Midtown in certain areas, it's like, I mean, it's literally half of what it was in 2019, which is better than what it was 2 years ago, but still not great. Then you walk around certain pockets like downtown in Brooklyn, it's like COVID never happened. So the community neighborhoody type areas are faring tremendously better than the kind of office business districts.
Yeah, and we saw that, the reopening. I mean, it was the residential areas that opened up faster, and they felt much more alive than any other parts of the city, whether that's Park Slope or Yorkville or the Upper West Side. I mean, the neighborhoods themselves where people lived were a completely different dynamic. And Ari, I'm totally on board with you. I love the idea of yes, there'll be some pain, but I think this idea of creative destruction coming to New York. I mean, New York is such a wonderfully dynamic city that yes, I think there's road bumps for a while. I'm in complete agreement with that. Are there going to be some weird conversions and some argued zoning agreements? Certainly, but I think the future of New York is going to be really, really interesting as the city adapts to sort of this new reality. That's something I'm really looking forward to.
I agree. And it's interesting if you, as I do and as our team does, if you interact with the individuals who are making housing decisions, forget about government officials, but if you talk to an individual who's making a decision to purchase a home, to rent a home, to move to New York City, to move within New York City, to raise their family in the city, to get married, with their spouse, whatever it is, if you interact with those individuals and you listen to them, the driving trends are, kind of community engagement, the desire to be in a walkable urban area with amazing food and culture and parks and, infrastructure and what have you, the connectivity of being around other like-minded individuals. None of that has changed. The thing that's changed is I can do all of that, to your point, living in Park Slope, Yorkville, Upper West Side, West Village, whatever, but I don't need to sit in a cubicle under fluorescent lights for 40 hours a week while doing it.
Yeah. Yeah. So many amazing little nuggets over here. And I mean, that attribute, that desire of the consumers for New York City, that's always there. That is staying real strong. And you guys talked about everything that you guys talked about with where this city's going and how we're going to navigate it. I got to tell you, the next 5, 6, 7 years are going to be real interesting. Watching this whole thing play out and watching the city deal with these things apace, and hopefully we go into a nice, a much better place, a much better place, and the city evolves like it always does. But I don't see the city going anywhere, to be honest with you. I think I'm bullish New York City at the end of the day. I just have to keep it real, and I have to be bearish when there's a reason to be bearish, of course, to be unbiased. But long term, I love New York City. And Ari, I got to tell you, thank you for bringing the human element. Thank you for going into the emotions of transactions, the mindsets of the buyers, and again, the human part of this industry you really touched about on so many different levels. Thank you so much for your time. I gratefully appreciate that. Ari Harkov, part of the one part of the amazing Harkov Lewis team over at Brown Harris Stevens. That is John Walkup. I am Noah Rosenblatt. This has been Talking Manhattan at Urban Digs, and we will catch you guys next time. Thank you, Ari.
Thanks, guys.